There are many questions regarding how to place stop-loss orders and which technique to follow. Although there isn't a single approach that is better than the other, knowing your options and how to place a stop-loss with different techniques is very important. So today we'll go through the most commonly used methods for setting stop-loss orders. Essentially, a stop-loss is a predetermined price at which you exit a position in order to limit your loss or protect your profit. A stop-loss is all about the exit strategy in your trading plan. Choosing which type of stop-loss to use depends on the goal of your trading strategy. For example, for a swing trading strategy, it makes sense to use a wide stop-loss to allow the price to rally and retreat as the trend rises. If you are a short-term trader, a smaller stop-loss will hug the price activity and help you not to give back too much profit when the rally finally ends. No matter what type of trader or investor you are, my advice is to always use a stop-loss order. Every successful trader knows where they will get out if a trade goes against them. They plan every trade before getting into it. Some traders are scared that if they place a stop-loss, the broker will try to cheat them by moving the price to the stop-loss level, causing a loss. This does happen, but it's no conspiracy. Getting stopped out is just part of trading, and the stop-loss itself isn't a problem. The point is that every trader will take the losses and have their stop-losses hit a lot. Therefore, using a stop-loss isn't really a question. As a trader, you need to control your risk and losses, especially when using the kind of leverage that is available to Forex traders, for example. So let's discuss the alternatives in terms of stop-loss placements. First one, moving averages. Moving averages are a popular tool, and they can also be used to place and manage stop-loss orders. Usually, a trader will use a moving average and then place a stop-loss on the opposite side to the current price. In this example, as we take a long trade, we could move the stop-loss below the 20 simple moving average as the trend unfolded. The moving average is thus also potentially ideal when it comes to finding a trailing stop method. A potential trade exit happens once price breaks the moving average. The big question about such a stop-loss strategy is which type of moving average to use. A fast moving average will get you in and out of trades relatively quickly because it reacts faster to price changes. A longer moving average is usually better suited for swing trading, where you aim to ride trends longer. And of course, during range markets, the moving average doesn't provide much help because price does fluctuate a lot around the moving averages. Next type, previous swing points. This is probably the second most popular way of placing and managing stop-loss orders. Here, you identify natural swing points on your chart and place your stop-loss below or above those points of interest. The trade exit happens once price breaks such a swing point. Also, many traders use intraday highs and lows, or previous day's highs and lows, to set their stop-loss orders using this method. If you are a breakout or a range trader, this way of placing stop-loss orders has to be adjusted slightly, and you should look for support and resistance areas to place your stops. Another alternative is Fibonacci levels. Using the Fibonacci stop-loss approach is especially interesting because it offers a more objective way of placing stops. Whereas you have to make decisions objectively when to move a stop based on the moving average or a swing strategy, Fibonacci levels don't have this component. Once a trader has drawn his Fibonacci levels, its potential stop-loss levels are well defined. In this example, we drew the Fibonacci tool during the downtrend and then used the retracement levels to trail the stop-loss. The trade exit happens once price failed to move to the next retracement level. Pivot points are another great way to set stop-losses. Pivot points are even more objective than Fibonacci levels because they are not set by the trader, but adjust every day based on price action. The way pivot points are used is the same as with Fibonacci. Whenever price breaks a pivot level, the stop-loss is trailed below that level. Pivot points are my favorite way of setting stops and managing trades because they adjust based on price action, market volatility, and momentum. During a strong trending market, pivot points are set farther away, and during a low volatility market, they are closer together. We also have volatility stop losses. Traders often set their stops too close when volatility is high, or they set stops too far away when the volatility is low, and thus reduce their potential risk to reward ratio. A volatility stop just like pivot points, adjusts based on the market context. Furthermore, a volatility stop loss can be combined with the previously discussed stop loss techniques. For example, if you use a moving average to place stops, you could add the volatility stop loss to understand how close or how far you have to set your stop loss to the moving average based on the current volatility and market context. There are several indicators you can use to take advantage of volatility stop losses, and chandelier exit is one of those indicators. Chandelier exit is based on the average true range indicator and is designed to keep traders in the trend until a defined trend reversal happens. Also, Bollinger Bands are rarely mentioned as a stop loss tool, but its usage of standard deviation makes it a natural candidate. For instance, the lower band works well as a stop loss for a long position and the upper band for a short position. As the Bollinger Band is not designed as a stop loss tool, it widens when the volatility is high. Hence, when you use it as a stop loss tool, remember to ignore the parts where the bands move away from the price. Adjust the stop loss only in the direction of the trade. And finally, parabolic SAR is another indicator that incorporates both price and time to place stop losses. Now let me cover the most common errors regarding stop placement to avoid if you want to take the best trading decisions. First error is not determining your stop placement in advance. You should know where your stop is going to be before you open a trade. The same goes for your entry and targets. The benefit of knowing your stop before you open a trade is that it removes any emotions from the decision, because you haven't yet risked any of your capital. Second error, placing your stop based on arbitrary numbers. The market doesn't care about your risk reward, some magic number 2% away from your entry, or some other figure. One of the biggest errors you can commit is to try to make the market fit your framework, as opposed to fit your framework to the market. While it'd be very convenient if there were some magic number or some equation you could apply to get a bulletproof stop placement, no such thing exists to my knowledge. Therefore, when it comes to deciding where to place your stop loss, that decision should be based on technical analysis. Stop placement should not be based on some magic price level which meets a certain percentage or gives you the desired risk reward. The market doesn't care for that. Another major stop loss mistake is moving your stop to break even as soon as possible. The goal of a stop is to protect you if your trade idea doesn't work out, and is not to offer you a risk-free trade the moment the market moves in your favor. Most people would agree that the stop should be based on technicals, yet happily move their stop to break even when the price moves in their favor. This is contradictory. Moving your stop to break even is similar to calculating your stop placement based on arbitrary numbers, the error we discussed before. The market doesn't care where you entered and where you're break even. The moment you move your stop to be safe, you also abandon a technical-based approach to the position, unless of course the break-even happens to coincide with a technically significant level. Another mistake is never moving your stop. As mentioned, the goal of a stop is to protect your account if your trade idea is incorrect. However, once the market proves to you that your trade idea may be accurate, as it moves in the expected direction, your stop can be used protectively to maintain a good risk-reward as the price heads towards your target. If you blindly move your stop to break even as soon as you can, that's an arbitrary decision which isn't based on technicals, it's just an emotional decision to feel safe. But if you move your stop as the market proves that it's moving in the expected direction, that's a decision based on technicals and a good way to maintain a good risk-reward ratio as price heads towards your target. The right value for a stop loss comes down to your trading time frame, your back-tested strategy results, and what you feel comfortable with. There is no right or wrong, and no single approach is better than the other. But it's important that you understand the pros and the cons of each approach and learn how to combine different aspects to form a trading method based on your preference and personal trading mindset. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel, and hit the bell icon to stay notified when we upload new videos. Until next time.